This is the Daily Market Rundown live from the Tradelo trading floor. It's May the 8th. Some highlights from today's show. The UK strikes a trade deal with the US. Powell is now on pause until further notice. And initial jobless claims data is in view. Good day traders and welcome. It is of course a sea of green across the European board. We can see the DAX flying up the page, now posting almost a 28% rally over the last 20 trading sessions. Quite just an incredible move that we're seeing in the German DAX. Of course this is a combination of things. I mean, it's this idea that tariffs are going to be a lot lower than expected, but at the same time of course we're also seeing the flows moving out of the United States into Europe. So it's just this continued theme of buy Europe versus sell the US. That being said, we can also see that following through into the US session, with of course the S&P being up just over 1% as we move into the start of the US cash session. Now, there's obviously a very good reason why we are seeing this sea of green, and that leads me to our first topic of today, which is this news that we got very early in Europe this morning around 2 a.m. That the UK will of course now be the first to strike a deal with the United States. Now, the important part about this is the devil will be in the detail, as it always is. This idea of deals coming down the pipeline is not new news. We knew there was going to be deals because that's why we got a 90-day extension, about a month ago. Now, the key to take away from it is we don't actually know exactly what's been agreed. We just know there is an agreement. What we do know to be true is this is the first part. It's sort of this high order level this is what we agree to, this is what you agree to, and as a result, we'll work our way now towards the finer detail. So this is going to be it's not going to be a handshake type thing. This is not going to be something that's signed into agreements immediately. Of course, this takes time. But what we need to understand as traders, what we have to really take away from this and what you have to be looking out for is two things. Number one, ultimately, how low will those auto tariffs go? Okay, we know that the US imposed a 25% auto tariff across the board, industry specific, to safeguard its own auto industry. Now, importantly, I'm going to stress this, auto makes up about 6.5% of the US economy. Okay, 6.5% of the total imports of the US economy. Okay, so it is a relatively large sector, but it's only 6.5% of the total imports. Okay, now why does that matter? Well, because we know that the reason for this trade wars is that the US feels like they are being hard done by everyone. Right? So yes, the 25% auto tariffs will matter, but they'll matter more for the other countries that it's being posed on rather than the United States. In other words, the impact of reducing this is not going to make a massive difference to the US, but it will make a massive difference to a number of countries, and we'll discuss those in a minute. Now, the key thing you want to take away from this is how low does it go? Okay, does it go all the way down to 10%? In other words, the lower base, or is it 15%? Okay, we just don't know. Now, the reason it matters is because whatever gets applied to the UK today will be assumed that it's going to be applied to the likes of Japan, to the likes of Germany, to the likes of South Korea, a number of the other big auto countries that are, of course, exporting to the US. Okay, that's the first thing to keep an eye on. The second thing to keep an eye on, and this is the major one, does that 10% blanket tariff remain? Everyone wants to know the answer to this, because the answer is if they are willing to waiver that, what this in essence means is that the effective marginal tariff rate could well be lower than 10% 6 months from now. And that would be massively positive for the market. And we'll discuss that in a moment when I get across to my scale. But those are the two things we're looking out for. How low can we expect those auto tariffs to go? And importantly, can the UK actually get a marginal rate of lower than 10%? Okay, if the answer is yes, lower than 10%, we're off to the races. Okay, you will see a significant bit up in risk markets. You will see a number of things going on. You'll of course see gold pair a lot of that risk off that we've had, priced in over the last couple of weeks. So just brace for that. It's very, very important. Now, should they come out and keep that 10% in place? Should Trump be adamant that that is as low as the US will go and there'll be that blanket 10% tariff across the board? Okay, I think perhaps that's a slightly different scenario in which now we're starting to get an idea of where we are on that marginal tariff rate. Now, I'm just going to skip ahead to my scale because it's important you understand the scale. I've been banging on about this for the last couple of weeks in the daily market rundown, but it's important you understand the scale because we started the year here. Think of this as the marginal tariff tax rate. This is the average tax rate the US charges on all imports, 2.5%. That's where we were on January the 1st. Then as we got into Feb and March, the market started getting an idea where we're going to see some sort of an increase in tariffs with a blanket tariff. Okay, we didn't know what the amount was exactly, but we knew it wouldn't be 2.5%. Okay, and that's when we started to see a little bit of risk off come in the equities. Then all of a sudden Liberation Day came and everyone went, oh shit, these numbers are a lot higher than we expected. He was putting 25% on Europe and 25% on Japan, eventually 140 odd percent on China, and suddenly everyone went, well, hang on a sec, it's actually somewhere in the ballpark region of around 30% now. Okay, so the point is that ever since Liberation Day, what's happened is we've been bouncing around here, trying to figure out where exactly are we on this scale. What is that marginal tax rate that's going to be charged by the US? Now, the lower that rate is, the more positive it is, the more certainty there is for industry. The higher it is, the more uncertainty it is. Okay, and that's why when we had the retaliation from the likes of Europe and China, of course we saw risk off because everyone said, whoa, it's a lot bigger than the 17.5% that Goldman Sachs was putting out there. Okay, so that's the key to the scale, and that's why I said if today, for whatever reason, the US announces that the UK can have an effective tax rate of lower than 10%, all of a sudden, for the first time in this entire episode, we're actually going to start to see the market lean on this idea that in the long run, remember markets are forward pricing mechanisms, 6 months from now, 12 months from now, effectively the effective marginal tax rate will be even lower than 10%. Okay, that's the assumption everyone will make, which is if the UK can strike a deal to perhaps get a 5% tariff rate increase only, well then so can Europe, so can China, so can everybody. Okay, maybe not China, but everyone can effectively get a better treatment than 10%. Okay, and that's why it'll be taken massively positive for the markets. All right, so keep an eye on that. Now, like I said, what happens if it comes out 10%? Okay, well, I don't think anyone's actually betting it will come in lower than 10% because we know that Trump's policy all along has been to make sure that people don't cheat ultimately the tariff system. They have to have a minimum level of tariff imposed on everyone. Okay, but it's not to say he's going to follow through with that. So if they do keep the 10% in place, it means that our marginal tariff is again going to be somewhere between 10% and perhaps that 17.5%. And then we'll spend the next couple of weeks and months banging around this area trying to figure out where exactly that marginal tariff rate is. Okay, now I've given it to you in a very oversimplistic way. I'm not an analyst. I don't work at a bank. I don't have all the high-level data to work out a massive formula. But this is the logic behind what big analysts are doing. They're trying to determine where that tariff rate will lie 6 months, 12 months, 2 years from now. Okay, that's the important thing to stress. Now let's go back a step. Because like I said, it's important to stress that ultimately imports of cars, ultimately, or the auto industry is only about 6.5% of the total, sort of amount of imports from the US. Now, why does that matter? Because I think the headline's probably going to be given to this idea of, the UK's managed to secure, on their autos a 10% rate or a 15% rate. And everyone's going to go, oh, that's wonderful. Think how good that is for Japan, etc., etc. But in reality, that doesn't change the landscape for the US significantly. Okay, it does change the landscape for the likes of Mexico and in particular Canada because they're massive exporters of cars to the US. It definitely changes the landscape for Japan. Okay, if you trade Japanese stocks, the car industry is going to do very, very well as a result of that. Okay, so it's more going to be industry specific and equity specific rather than positive for the general indices. Okay, very important you understand that. Now, this is our grid, okay, and this is why it matters. Because if the UK gets something good today, okay, we know that the UK is the 7th largest trade partner for the US, and of course we can kind of exclude Mexico and Canada because we know there's going to be favorable deals there because there has to be. They are such big trade partners. We of course know China's its own situation, and that's going to be dealt with starting perhaps this weekend, and that will definitely come down at some point in the future. So very much what we can start to do is say, well, look, if the United Kingdom can secure a really good deal, we can start to assume that the same thing can be applied to Germany, Japan, and South Korea. Okay, in other words, if the UK can get less than 10%, it means that it's very likely Europe can bring its marginal tax rate down from the 25%, perhaps down towards 10%, whatever it might be. Okay, and the same with Japan, the same with South Korea. Okay, so the market's going to start to forward think. They're going to take whatever the UK does and they're going to apply it to some of the biggest trading partners that we could see on the grid. Okay, and that's how you have to go into thinking about this. So definitely keep an eye on that as we get to that announcement around 2 p.m. GMT. So it's about an hour from now. Then turning to, obviously, the other news, it was all about Powell. And the key takeaway from that is very simple. We're not going to cut unless there's a significant slowdown in the data. There's too much uncertainty. We don't know what the tariffs are going to do. Are they going to be inflationary? Are they going to cause unemployment? We just don't know. Okay, that was the key takeaway. He did try the attempt to talk tough on inflation and promised to do whatever it is to keep inflation expectations anchored. But in reality, they just don't know what to do. They spoke a lot about this idea of we will assess how far we are from the mandate. Now, to explain that in a very basic sense, okay, if your mandate is 2% inflation and you're sitting at 5%, okay, and unemployment is at 4% and it's expected to creep up to 4.2%. The reality is that, sure, we don't want to see unemployment creep up, but right now, in terms of what our mandate suggests, we are far further away from that 2% inflation target than we are from price stability, or than we are, from stability within the unemployment market. Okay, and so they will favor the inflation side of the mandate. They will therefore turn more hawkish and perhaps open the door to no cuts this year or no cuts and perhaps even rate hikes. Okay, that's what they mean by understanding the degree from which they are from their targets when it comes to employment and unemployment. Okay, so they are gauging this in terms of which one is going to be more impacted when we actually start to see the implications of tariffs. Now, I think there was a comment from Goodluck which was very, very interesting. He was talking about a 4 handle on the inflation print by the end of this year. Okay, so think of inflation back at 4%. If we do have inflation prints of 4% by the end of this year, you can bet your bottom dollar that we are a lot further away from the inflation mandate than we will be from the employment mandate. Okay, so what that means is brace. It's very possible that rates do not get cut at all this year, and it's of course even more possible that we do, see rates stay at these levels for an extended period of time. Okay, I think that was the key takeaway. The market again didn't do anything. There was nothing really taken away from it. This was a summary I posted on the Twitter after the meeting, and again, I think one of the key takeaways is if you think about what Besson told us 2 weeks ago. He said, look, we're not going to have we'll have the outlines of deals, of course, in the coming weeks, but in essence, only 80 to 90% of countries will have some form of a deal by the end of this year. Okay, now they're very purposely using this word end of this year because whilst we've been given a 90-day extension, the reality is that this is going to take a hell of a lot longer than 90 days. Okay, so what they're trying to do is prepare the market for this idea that we'll have the broad outlines of what tariff deals might look like in the first 90 days, but then it'll be ongoing discussions that'll continue well into the end of this year. Okay, now what this means ultimately is that Chairman Powell is probably over the next 90 days going to start to get an outline of what the marginal tariff rate might be, and at which point they can then start to understand or model at least what the implications will be for inflation and unemployment. Okay, but the reality is that until we get those tariffs in place, we're not going to see big industries start to import and export. Okay, and so what happens is there's a delayed effect here where we're not going to actually see the implications for at least another 60 to 90 days. Okay, and then of course there's the lag effect of it hitting the hard data. So the point is that we're not going to know for another 3, 4, 5 months effectively what the implications of these tariffs are. What that means is Chairman Powell absolutely won't be in a position to do anything about it until later on this year. Okay, so first cut, possibly September, but like I said, it's very much a case of if the economic data falls over a cliff, if we suddenly get non-farm payrolls coming out next month at 50,000 jobs, you can bet your bottom dollar they'll be cutting in July. Okay, so what that means for US traders is hard data really matters. Okay, the markets will be very aggressively trading off of the hard data, and hard data will be very volatile for the markets going forward. Okay, now with that in mind, let's turn our attention and have a look at what the 10-year did. This is the weekly 10-year chart in green, and what you could see is that as of the close of yesterday's session, we smack bang at the starting point of this week, 431 yield. We've absolutely moved nowhere. If we cast our minds back to Liberation Day, we can see we're still about 40 basis points higher than Liberation Day levels. Why does that matter? Well, because the bond market is sending a very clear indication that the tariffs are going to be more inflationary than they are going to be recessionary. Okay, that's how the market's reading this. If it was recessionary, you'd see these yields a lot lower, but it's up because it's more inflationary. Okay, so the verdict from the bond market is right now the economy is solid. There's nothing to worry about from a growth standpoint. Sure, we got a little bit of a growth slowdown, but there's no recessionary pricing in the bond markets currently. It's more inflationary that the bond markets are pricing. Okay. With that in mind as well, we continue to see that curve steepen, suggesting that the Fed, if they were to cut rates, of course, they are going to send inflation expectations much higher, and as a result, long yields will, of course, move higher as well. Okay, now turning our attention to our key data point for the day, it is one to watch. If you were listening to Powell last night, you'll heard he mentioned the initial jobless as a hard data point. It is one they watch for the simple reason that it's a very good leading indicator on the non-farm payrolls. It is, of course, out every single week. And it is seen as a forward-looking data indicator. Why? Well, because it's kind of like an on-the-ground survey of how many people are looking for unemployment benefits. Okay, so ultimately, week by week goes by, you get more people dropping out, looking for some sort of a wage from the government, and so looking at this data can give them a lean as to are we about to see a significant drop-off in the labor force? Are we about to see unemployment spike higher? Okay, that's why they look at it very closely. Now, with that in mind, the reason I'm saying this week could be interesting is because last week we had a very, very unexpected tick up. Okay, it was one of those sort of head scratches where you looked and you went, hello, that was interesting. Now, again, it's not to say that this data point can't be volatile. Of course it can, and we could see that volatility in the absolute change. But one data point doesn't make for a trend. Two, we start to pay attention. Three, we start to take notice and of course, apply some forward thinking from that point. Now, what that means is keep a close eye today. I think the number is expected in around 230. So we're a little bit lower than last week, but should we see a number above 250? Okay, again, it's another one of those big upticks, unexpected. Okay, so 2 data points will start to cause some interest. A number above 260, that is, of course, the highest since going back to 2022, and it will start to cause some concern. Now, what are you looking for in terms of the data? What sort of starts to lead the market into this idea that this is going to lead to some significant slowdown? Well, what I've got for you here is 2008. Okay, because what happened in 2008 was we of course had Lehman all the way at the end of the year, October, November, but we started to see the initial jobless really start to move higher in terms of that purple line. That's the moving average, the 4-week moving average. Okay, and we started seeing that leaning up and to the right already in late 2007. But we saw a couple of very, call it smelly prints, sort of in the start of Q3, where we started to see an acceleration almost in the initial jobless. Okay, now keep in mind the recession sort of only started up with somewhere up here, so they only started calling this a recession much later on, well beyond or well after, of course, the initial jobless started showing some concern. Okay, so keep a close eye on it. Like I said, if I go back to that chart, anything above 260 today, you're gonna start to see people scratch their heads. You're gonna start to see people modeling in this idea that what is the implications for, of course, the non-farm payrolls. All right, with that in mind, of course, we also do have a 30-year auction today that will be very closely watched. We did, of course, have the 10-year auction out on Tuesday that was absolutely solid again. So I don't think there's any risks of the 30-year auction going badly, but we watch it anyways because if there is a bad 30-year auction, it is, of course, going to just create a whole bunch more uncertainty at a time when the markets can't afford it. With that in mind, of course, if there are any other questions, do post them in the Discord channel. Like I said, we've got that initial jobless coming out in just about a half an hour, and then we do have Trump with his wonderful announcement at 2 p.m. GMT, and then, of course, the auction at 6 p.m. GMT. So a number of things to keep a close eye on. Do stay focused, and as always, manage that risk. Good luck out there. Go make some money.